Hello, guys. Hello, everyone. Welcome to Infinite Floating Stocks. I am Venkat. In this session, I'm going to explain you about long put options strategy. I repeat, in this session, I'm going to explain you about long put option strategy. Okay. In our previous session, we talked about long call option strategy. Which is nothing but uh, I mean, buy call option strategy. Long is nothing but buy, short is nothing but sell. Okay. So in our last session, we talked about long call option strategy. So which is nothing but when you expect a bullish market, we buy calls. Okay. And when we expect bearish market, when you expect that market gonna fall, in that scenario, uh, you should be buying puts. Okay. So buying put is also called as going long on put. Okay, so name of the strategy is long put option strategy. Okay, so let's start. All right, these are the contents for today's session. So I'm going to talk about what is long put option strategy and which strike prices to choose when you're dealing with long put option strategy. And also, of course, we should be talking about risk and reward. What will be the risk and what will be the reward when you're dealing with long put option strategy. Okay. And break even points. Break even points are very important. Break even is nothing but a point where break even point is a point where we don't get any profit and any loss. Nothing but 0 point. Okay. Break even point is also called as 0 point, a point at which we don't get any profit and any loss. Okay. So I'll be discussing about break even points and loss. I mean, what will be the maximum loss or what will be the maximum profit when you're dealing with long put option strategy. Okay. And payoff chart, you already know the importance of payoff charts. Okay, so you should be looking at payoff charts when you're dealing with uh, strategies related to features and options. Okay, payoff chart is very important, which will help you analyze the maximum amount that you're gonna lose or the maximum amount that you're gonna gain when you're in a position. Okay, so it's very important to understand payoff chart without any uh, you should be very clear with payoff charts and you should be understanding it very clearly. Okay, before taking any option positions or positions related to options. Okay, and effect of volatility on longer put option. Okay, and we'll be discussing about effect of theta, which is nothing but time decay. So in our last session, I told you that if your target is achieving late, if your target is taking more time, then that means because of that time, if it takes more time, time decay happens. Okay, which is nothing but theta has a negative value. Okay, if your target is getting hit very late, then theta will have negative impact on your uh, on your long calls and long puts. Okay, so I'll help you in understanding the effect of theta on long put strategy in this session. Okay, and I'll be telling out few very important points that you need to keep in the mind while dealing with long put option strategy. Okay, all right. What is long put option strategy? Long put option strategy. So before that you need to have this market outlook. Okay, so it's very important to remember this table. Okay, so if you're having bullish view, you need to buy call or sell put. Okay, if you're having bearish view, then you need to buy put or sell call. Okay, so in this session we are going to talk about which scenario. I told you that we're going to talk about buy put option strategy. Okay, this is buy put, which is nothing but we're going to talk about if you are having a bearish view and if you are choosing buy put option, if you are using buy put option strategy, then what will be the risk, what will be the reward, what should be the break even, and which strikes to choose. I'm going to explain you each and everything. I'll be explaining you in and out everything in and out relating to buy put option strategy. Okay, if your view when your view is bearish. Okay, all right. So what is long put option strategy? So let's formally go through the definition. If you don't understand definition also, don't worry. I'll be explaining you in my own terms in very simple language. Okay. So The long put option strategy is the most basic option trading strategy. So there is nothing in first line. Okay. So long put option strategy is nothing but it's a very, I mean, it's very basic. It's the most basic option trading strategy whereby, which is nothing but wherein the option trader, who is an option trader? We, right? So the long put option strategy is the most basic option strategy wherein, whereby the option trader, nothing but we, buy. What we are doing? Buy is nothing but going long. Long put option strategy is nothing but buying put option. Okay. So we buy put option with the belief that the price of the underlying asset or underlying security, which is underlying security and underlying asset, our Nifty, Bank Nifty, or some Tata Motor stock, or some Reliance stock, or TCS, or Infosys stock, etc. All these are underlying assets. Okay. So long put option strategy is the most basic option trading strategy wherein the option buyer, I mean the option traders, nothing but we buy put options. What we are doing? We are buying put options when with the belief that the price of underlying asset, nothing but with the belief that in Nifty or Bank Nifty or Tata Motors will fall, nothing but it is going down, nothing but the view is bearish here. Okay. With the view that, with the belief that the underlying security will fall significantly beyond the strike price. Okay, beyond the strike price, nothing but you need to buy some strike price, estimating that the market will stay below that strike price for sure. I repeat, you need to be choosing the strike price, and you need to expecting that that market will definitely, I mean, the market will be staying definitely below that strike price. Okay, so you need to be selecting that type of strike prices when you're dealing with long put option strategy. Okay, all right. Once again, okay, I'm gonna explain the definition once again. Okay, so the long put option strategy is the most basic option trading strategy whereby the option trader, nothing but we, buy put options. What we are doing? We are buying put options when, with the belief that the price of underlying asset, nothing but we'll buy put options when we expect Nifty or Bank Nifty will fall. Okay, will fall significantly beyond the strike price. That's it. Okay, simple. So before the expiration date, this is very important. You need to choose the expiration date. Okay, so yeah, in simple words, we buy put option if we expect bearish market. That's it. If you're not understanding the definition, don't worry. Just go check the previous slide. What I wrote here. If you're having bearish view, you need to buy put option. That's it. Remember the one point. Okay. See what I have wrote here. The second point. We buy put options if we expect a bearish market. Okay. Just remember that thing. If market is going down, we buy puts. If market is going up, we buy calls. Okay. In previous session, we talked about bullish view. Okay, and buying call option strategy. In this session, I'm talking about bearish view. Okay, which is buying put option strategy. In previous scenario, we bought calls. In this scenario, we are buying puts because our view is bearish now. Okay, all right. Which strike price to choose? This is very important. There is lots of confusion among most of the students regarding, oh my god, what strike price should I choose? What expiry should I choose? Or before choosing strikes, which I mean, do I need to check OI or change in OI or wicks, or I mean, what are the different types of analysis that I need to do before choosing strike prices? There are lots of confusion among most of the students. Okay, so I'm gonna wipe each and every confusion in next few minutes. Okay, I'm gonna explain you each and everything in a very detailed manner in next few minutes. Okay, just stay patient. Okay, so which strike price to choose? Simple. So focus on ATM strikes or slightly OTM strikes. So what is ATM? ATM is at the money strike. Okay. OTM. What is OTM? OTM is out of the money strike. Okay. So in option chain table, what is the color of OTM strikes? Yes, you are right. So the color of OTM strikes is white. Okay. So let's get on to option chain table. All right, guys. This is option chain. How to open this? Simple. Go to Google. Just type option chain. Click on enter button. Click on this first link, and the link is www.one.nseindia.com. So click on this link and table will directly get opened. Okay, so this table is called option chain table. We also called as option chain matrix. We also call it as option chain matrix. Okay, so you'll be saying seeing yellow color, I mean data present in yellow color and data present in white color. Okay. Towards left side of the screen, towards left side of the table. And coming to towards the right side of the table, same, you will be seeing white color, white data present in white color, and also you will see the data which is present in yellow color. Okay. So if the data is present in yellow color, that means that's in the money strike option. Okay. So left side of the table is, I mean, the data which is present towards the left side of the table is related to calls. Okay. So data which is present towards the right side of the table is related to puts. Okay. So if the strike price is in yellow color, that means in the money option strike. Okay. See, yellow color is at the top left. Okay. When you're dealing with calls. So this is in the money area, in the money call option area. Okay. So this is in the money put option strikes. All these are 14,350, 14,400, 14,450, 14,500. All these are in the money put strikes. Okay. So what is out of the money put? This is all out of the money. White area is out of the money. Okay. So this is out of the money puts and this is out of the money calls. Why calls? Because left side of the table is data related to calls, right? So this is out of the money calls data and this is out of the money puts data. Okay. So if I select 13,800 put, that means that strike is out of the money. If I select 14,600 call, that means that is out of the money. Okay. So if I select 14,750 put, this is 14,750 and put. So it's falling under yellow area. Then that means in the money strike, in the money put strike. So if I select 13,800 call, where is 13,800 here? So 13,800 call. So it's falling in yellow area. That means it's in the money strike and it's towards the left side of the table. So we call it as in the money call strike. Okay. In the money strike of call option. Okay. So it's pretty simple. If strike price is in yellow area, then that's in the money call option, in the money strike. And if the strike price is falling in white area, then that is out of the money strike. Okay. So if it is staying towards left side of the table, then it's call. I mean, that means the strikes and data related to calls. And if it is staying towards the right side of the table, then that means that data and strikes are related to puts. Okay. All right. I'm expecting that you guys are pretty clear with what is in the money, what is out of the money, and I mean, where can you see data related to calls and where can you see data related to puts? And also, I'm expecting that you guys are pretty clear with how to open option chain data. Okay. So just go to Google, just type in option chain, click on the first link, which is related to NSE website. Open that link. With that link, I mean, that that link will directly help you to populate into a table. Okay. So that table is option chain table. Okay. So yellow area is nothing but in the money strikes. White area is nothing but out of the money strikes. Okay. All right. So what's our first point? First point, focus on ATM strikes. Okay, what is ATM strike? It's just nothing but at the money strike, which is nothing but uh, strike price which is close to last traded price. What is Nifty's last traded price? It's 14,343. Okay, so this is last traded price of Nifty, which is 14,343. Okay, so now tell me what is at the money strike? 14,343 is close to 14,300 and 14,350. Okay. So these two are at the money strikes. 14,300 is at the money strike and 14,350 is at the money strike. Okay. So you need to focus on at the money strikes. See, that's the first point. Focus on at the money strikes or slightly OTM strikes. What is slightly OTM? See, what is slightly? Say we are dealing with put option. Okay. The strategy is buy put option strategy or long put option strategy. Okay. So what I wrote, you need to be dealing with ATM strikes or slightly OTM. OTM is white area towards put. Okay. So this is white area towards put. See, this is white area towards put. So what is slightly OTM? 14,250 and 14,200 and 14,150 are slightly OTM strikes. Okay. I repeat, you need to be focusing on at the money strikes or slightly out of the money strikes when you're dealing with long put option strategy. Okay. So in our scenario, at the money strikes are 14,350 and 14,300. and out of the money or slightly out of the money puts are, or slightly out of the money strikes are 14,250 and 14,200 and 14,150. See, 14,150, and we are dealing with puts, so it's falling in white area. So it is out of the money strike. Okay, so 14,150, 14,200, and 14,350. These three strikes are slightly OTM strikes. Okay, all right. So you need to be dealing with, or you need to be choosing at the money strike or slightly OTM strikes. So I have shown you at the money strikes and also slightly OTM strikes. Okay. When do you choose? When you are bearish and wanted to buy put options. Okay. So when you I imagine that you have made some analysis. Okay. I'm expecting that you already, I'm expecting that you guys have been through our bronze and silver memberships, which includes each and everything related to equity strategies, swing trading strategies, and commodity strategies. And it also includes risk management, money management, and trading psychology, and how many quantities do you need to take with the capital that you are having, and what should be the risk and what should be the reward when you are dealing with equity strategies. So lot many things were part of bronze and silver membership. I'm hoping that you guys are through that, and I'm expecting that you guys already know uh, what are chart patterns and different candlestick patterns, and all those were taught. uh, all those things were included in bronze and silver membership. I'm expecting you guys are pretty clear with all these things. Okay, so imagine that you have made some analysis, and you're expecting that the market gonna fall down. Okay, so in that scenario, that means the market gonna fall down, which is nothing but it's bearish. Your view is bearish now. Okay, so what do you need to do? You need to focus on ATM strike. You need to choose ATM strike or slightly OTM strikes. Okay. And when you wanted to buy put option, because the market is falling down, if it goes down, you need to buy put or sell call. Okay. So I'm going to explain you about selling call scenario in upcoming sessions. Okay. Let's talk about buying put scenario now. Okay. So if market is going down, you need to buy put. So which strikes you need to choose ATM or slightly OTM strikes. Okay. So more or deep the OTM strikes you choose, more bearish you are on the Stocker index. It's very simple. Let's get back to option chain data. Now see, what's the current price of Nifty? It's that 14,343. 14,343. Okay. So now see, which is nothing but imagine that it's pretty close to 14,300, which is our at the money strike. Okay. So if you choose 13,800, what does that mean? That means you are expecting that market will fall from 14,300 to 13,800. Okay, that means you are more bearish. I repeat, 14,800 is very deep OTM strike. Okay, see 13,000 OTM, and we are dealing with puts. It's in white area, so it is out of the money strike. Okay, so if you choose 13,650 strike of 14th January, that means you are expecting that market will fall from 14,300 to 13,650 before 14th of January, nothing but before next weekly expiry. That means you are more bearish. You are expecting that market going to fall from 14,300 to 13,650. Okay. So the more DPM you go, I'm so sorry. The more deep OTM strikes you choose, the more bearish you are. Okay. When you are dealing with long put option strategy. I repeat, I repeat, if you select 13,200 strike, we are dealing with long put option strategy. Okay, so this is 13,200 and put, which is nothing but white area, so it's out of the money strike. Okay, so if you choose 13,200 strike, and if you are estimating, if you choose 13,200 strike, that means you are expecting that market gonna fall from 14,300 to 13,200. Below 13,200. That means you are expecting that market gonna fall from 14,300 to 13,000. You are expecting that market gonna fall from 14,300 to 13,200. Below 13,200 before next weekly expiry. Okay, that means you are more bearish. The more deep OTM strikes you choose, the more bearish you are. Okay, that's the statement. I hope you guys got it. If you're going more deeper, if you choose more deep OTM puts, that means you are more bearish. Okay, see what is LTP? LTP is premiums price. See, if you choose deep OTM, price is very less, it's only 5. If you're coming closer to ATM, say it's 30 rupees here, premium is 30 here. So if you're coming down, when you're coming close to ATM strike, premiums are getting increase. Okay, but if you choose, I mean, if you imagine that the price is very, I mean, the premium is very less, so I'll buy this. If you are with like that mindset, then that will be a huge loss for you. Okay, so don't think about premiums. Don't think that if premiums are less, then I will buy. Okay, don't think like that. So in that scenario, you are expecting that market gonna fall very badly, so which cannot happen. Which may happen, but that's very rare. Okay, so you may lose money if market not gonna fall very badly. Okay, so do not go or do not choose deep out of the money put strikes when you're dealing with long put option strategy. Okay, I repeat, the more deep OTM strikes you choose, the more bearish you are. Okay. So out of the money strikes, I mean, the premiums of out of the money strikes will be very cheap. Okay. So, but do not tempt for those cheap premiums. Okay. They appear cheap, but I mean, they are not very profitable. Okay. See, 13,150. Look at the premium of 13,150 and look at the premium of 13,000. It's just 3 rupees, 5 rupees, 6 rupees. Okay. All these are deep out of the money strikes. They are very cheap. They look very cheap. But if we fall for the trap, I mean, they look very cheap, but they are not very profitable. So I suggest you guys to not go very deep when you're dealing with long put option strategy. Okay. So select only ATM strikes or slightly OTM strikes, which are nothing but 14,250, 14,200, 14,150, and 1400. That's it. Not below that. Okay. So, all right. More or deep the OTM strikes you choose, more bearish you are on stock or index. I hope you guys are pretty clear with this point as well. All right. So the more bearish you are, the further OTM strikes you buy, you can buy the put option. Okay. That's what I have explained. Let's move forward. All right. Here comes the amazing questions. Amazing. Here comes the amazing slide. Okay. So there is a lot of doubts in lot many students saying that how much we'll be losing when you're dealing with this strategy, how much we're gonna get if you're dealing with this strategy. So you need to learn about risk and reward before entering into any strategy. Okay, so let's talk about risk and reward when we are dealing with long put option strategy. Okay, all right. So risk is very limited when you're an option buyer. Yes, we are an option buyer because you are buying put when market is going down. Okay, so you're an option buyer. If you're an option buyer, that means you are paying premium and entering into option contract. Okay, that means you are getting the right. Okay, if you're having the right, you will get the right when you pay the premium. Okay, that means you are an option buyer. Okay, so risk is very limited if you're an option buyer, and risk is limited when you are long on put option. Okay, I repeat, risk is limited when you're option buyer, and risk is limited when you are long on put option. Okay, all right. So risk for long put option strategy is limited to the price paid for the put option. What is the price paid for put option? Nothing but you'll be paying the premium and signing the option contract, right? So in the similar scenario, uh, price paid for the put option is nothing but premium paid. Okay, so risk for long put option strategy is limited to price paid for the put option, which is nothing but premium paid, and no matter how high the stock price is trading on expiry date. Okay. Oh yes. I mean, yeah. Ignore. I'm gonna explain you that in very simpler words in next slide. Okay, if you don't understand this third point, ignore. Okay, I'm gonna explain you in very simple words in next few minutes. Okay, so I repeat, for the long put option strategy, I mean, risk for long put option strategy is limited to price paid for the put option. Nothing but you're gonna pay premium and enter the put option, right? So what happens if market goes against you? Imagine that you are bearish, you are expecting the market gonna fall down, So you bought put. Okay, you bought put, nothing but you are buying put option by paying some premium. Okay, so imagine that market didn't fall, it went up instead. Okay, that means your view went wrong. Okay, in that scenario, how much you gonna lose? You'll be losing only the premium which you have paid for buying put option. I repeat, if your view goes wrong, if market goes up instead of going down, in that scenario, you'll be losing only the premium you have paid before entering long put option strategy. Okay, that's it. Before buying put option. Okay, that's it. So if you don't understand this formula, ignore. Anyway, you're gonna understand this when we are on to payoff diagrams. Okay, so the formula for calculating maximum loss is given below. Maximum loss is premium paid. That's what I have explained. If your view goes wrong, if market went up instead of falling down, in that scenario, you'll be losing the premium which you have paid for entering long put, long for buying long puts. Okay, for going long on puts. Okay, so you'll be losing the premium. That's it. If your view is going wrong. Okay, so max loss occurs when price of underlying asset greater than equal to strike price of long put. So I'll explain you this with payoff diagram. Okay, so max loss occurs when price of underlying. Okay, let's get on to payoff diagrams first. So this is Opstra strategy builder. I'm expecting that most of the students here know what is an Opstra strategy builder, how do we use it. Okay, I already explained you about this in my previous session. So yes, it's pretty simple. Just type Opstra in Google, click on enter. So this is the link, https opstra.defineedge.com. Okay, so click on that link, then click on get started, then here we go. Okay, so this is a layout that opens up when you click on get started. Okay, so imagine that we are dealing with Nifty. Okay, and we are dealing with options. Okay, and let's select 14th January as expiry. Okay, 14th January. So let's what is the current price of Nifty? It's 14,347 here. Okay, so current price of Nifty is 14,347. So here we are bearish. Okay, so let's expect market gonna fall down below 13,800. Okay, so 13,800. 13,800. Okay, so what we need to do, if you're bearish, we need to buy puts. So select PG and buy. I repeat, we are dealing with Nifty here. This is just an example. Okay, so we are dealing with Nifty here, and the current price of Nifty is 14,347, and we are expecting that market gonna fall beyond 13,800 before 14th of January 2021. I repeat, here we are dealing with Nifty, and current price of Nifty is 14,347.25, and we are expecting that, I mean, this is an example. Okay, so if you are expecting that market gonna fall down beyond, I mean, beyond is nothing but if you are expecting that market gonna fall below 13,800 before 14th of January, before 14th of January, then you need to buy puts. Okay, so imagine that we are expecting the market gonna fall down beyond 13,800 before 14th of January. So what we need to do, we need to buy put. Okay, so this is PG and I'm buying put. Okay, now see, this is risk reward, this is payoff diagram. Okay, after clicking on add position, I will be able to see this payoff diagram. Look at the payoff diagram. So before 14th of January, if Nifty doesn't fall, imagine that my view went wrong. Okay, imagine that my view went wrong. So and Nifty didn't fall below 13,800. Okay, so what can happen in that scenario? See, this will be the loss I'm gonna face, which is nothing but just 1,279 rupees. I repeat, instead Nifty, I mean, imagine that my view went wrong and Nifty didn't fall below 13,800 before 14th of January. Okay, in that scenario, I'm gonna lose just 1,279 rupees, which is nothing but premium paid. Okay, so let's calculate that. So let's calculate that. What's the premium? premium is 17.05. 17.05 into, so Nifty 13,800, right? 13,800 Nifty PE 14th of January. So Nifty 14th of January 13,800, adding to watch list, and I'm clicking on buy here. Okay, so it's 75 quantities. Okay, so 75 into 75 into 75. So how much you gonna lose? You will be losing to 1,278.75. So let's get on to payoff diagram. What it is showing. Look at this figure. How much you gonna lose? 1,278.75. Look at here. How much you gonna lose? 1,279, round figure. Okay. So you're gonna lose only 1,279 rupees if your view goes wrong. If you're long on put option, expecting that market gonna fall beyond 13,800 before 14th of January. Okay. So if your view goes wrong, you'll be losing only 1,000. So what happens if your view goes right? Imagine that market fell badly before 14th of January, and imagine that it went down to 13,571. Look at the profits. You'll be having profit of 15,896. Okay. So imagine that it fell very, very badly because of some other external factors. Now see, so if it fell down to 13,338, now look at your profit. Your profit will be 36,371. Okay. So imagine that it fell very bad, and it reached 13,170 before 14th of January 2021. Okay. In that scenario, you will be gaining 45,971. Okay. So in this strategy, the profit is unlimited. Look, if market is going down to zero before 14th of January, then you will be gaining the most. Okay. So the more it falls, the more profits you get. I repeat, if your view goes right, the more fall happens, the more profits you get. I repeat, if your view goes right, if market falls below 13,800, the more it falls, the more profits you get. Okay. If it is going down to zero from, what's the current price? It's 14,300 change. Okay. Imagine that Nifty went down to zero from 14,300 change before 14th of January, then you will be having maximum profits. Okay. So in this scenario, in long put option strategy, your profit potential is unlimited. Okay. The more fall happens, the more profits you get. Okay. So if your view goes wrong, imagine that it didn't fall. It went up. Okay. Imagine that it went up to 13,988. So how much you gonna lose? You're gonna lose only 1,279. Okay. Imagine that it went till 14,879. How much you gonna lose? You're gonna lose only 1,279, which is the same amount you're gonna lose, not anything less or more than that. Imagine that it went to 15,361 instead of falling down to 13,800. Okay. So in this scenario also, you're going to lose only 1,279 rupees, which is same. Okay. So here your risk is limited if your view goes wrong, but if your view goes right, look at your profit potential. Okay. The more fall happens, the more profits you get. Okay. If your view goes wrong, look at your risk. It's very limited. You'll be losing only 1,000. But if your view goes right, look how much you're gonna gain. It's unlimited. Okay. So that's all about risk and reward. So if you don't need to remember any formulas regarding to risk and reward. Okay. Just get on to this Opstra strategy builder website and add your positions. Before taking any position, add them here. Click on add position, and then look at your risk reward and take your decision according to it. So if you can afford losing 1,279 rupees, then you can enter into this strategy. Okay. If Nifty falls, then you will be gaining. If Nifty doesn't fall, you will be losing only 1,000. So 1,000 is very small amount, right? So if you expect the fall gonna happen, and if you expect that 1,279 is under your risk, then you can enter this strategy and stay calm. Okay. If it falls, you'll be in unlimited profits. The more fall happens, the more profits you get. If it is not falling, instead if it's going higher, anyway the risk is very small. You'll be losing only 1279 rupees. Okay, so which is nothing but premium paid. I already showed you how to calculate it. It's very simple. See, what's the premium here? 17.05. So 17.05 into how many quantities? 75 quantities. Okay, so I'm dealing with 75 quantities, which is one lot. So I'll be losing only, so 17.05 into 75, which is nothing but 12, 1278. Okay, I'll be losing only this much. So which is nothing but I'm paying 1278 to enter into put option, to buy put option. So this is the premium I am paying, and I'm going to lose only the premium which I have paid. Okay. All right, let's get on to slides. So risk is limited. You already know. Risk is limited. You already know when you're an option buyer and when you're long on put option. Okay. So risk for long put option strategy is limited. You already know, and you'll be losing only premium paid. You already know, and no matter how high the stock goes, I already told you, risk is limited. Even if it is going down to 16,000 instead of falling down to 13,800, you will be losing only 1,279 when you're dealing with one lot. Okay. All right. So maximum loss is premium paid, and maximum loss occurs when price of underlying asset greater than equal to strike price of long put. Okay. So where is Obstra? Now see, 13,800 is the strike you have choose. Okay. Now see, if Nifty is at 14,445, that means that is greater than the strike which you have chosen. Okay. So you'll be in loss if market is going above the strike which you have chosen to buy put. Okay. So maximum loss occurs when price of underlying asset greater than equal to strike price of long put. Even if you're not understanding this, no problem. Go on to payoff diagram, scroll the mouse and understand. It's pretty simple. Okay. All right. What's reward? I already explained you. Okay. So let's run through this slide with little more speed. Okay. So profits are unlimited when you're an option buyer, because we are here buying put. We are buying put because we are bearish. Okay. We are an option buyer because we pay premium and get the right. Okay. If you're having right, you are buyer and your risk is limited and profit is unlimited. Okay. So profits are unlimited. Profits are unlimited when you're dealing with long put option strategy. Okay. When you're an option buyer. Okay. Profit is unlimited. So since stock price in the theory can reach zero at expiration date, the maximum profit possible when using long put option strategy. That's what I told, right? So the more fall happens, the more profits you get. Okay. If Nifty is falling down to zero from 14,300, then that means you're gonna gain the maximum profit. Okay. So the more fall happens, the more profits you get. If it is falling down to zero, then that means you're gonna get more profits, the maximum profits. Okay. So the best that can happen is for stock or index price to drop down to zero. Okay. It cannot get into negative. Okay. So Nifty cannot get into negative, or some Tata Motor stock price cannot go negative. Okay. So the maximum fall that can happen is zero. It can reach zero. Okay. The more fall happens, the more profits you get. So if Nifty is falling down to some 2000 or 3000 from 14,000, that means 2000 and 3000 is below 13,800, which is the strike price which you have chosen. Okay. So the more fall happens, the more profits you get. That's it. Okay. So formula for calculating profits, pretty simple. The maximum profit is unlimited. You already know this. Maximum profit is achieved when price of underlying asset is zero. Yes, when Nifty is falling down to zero, you'll get maximum profits. Or when Tata Motors is falling down to zero, then you are gonna get more profits, right? Okay, that's what I have explained. Okay, so if underlying asset, which is Nifty or Bank Nifty, if it is falling down to zero, then you will be getting maximum profits. Okay, so profit. So profit is strike price of long put minus premium paid. Okay, so if you don't understand this formula, no problem. Get on to chart, payoff chart or payoff diagram, you're gonna understand it. Now see what's the formula for profit. Profit is achieved when strike price of long put minus premium paid. Strike price of long put. Let's get on to calculator. What's the strike price of long put? Strike price of long put is 13,800. See, 13,800 is the strike which I have chosen to go long. PE buy. Okay. So 13,800 is the strike that we have chosen to go long, minus, that's a formula, right? Minus premium paid, minus 17. What's the premium that we have paid? All right, it's 17.05. Okay. So you will be in profits when market falls below 13,800 and 13,782. Okay. So 13,782 is the break even point. See, look, the line was straight till here and there is a small curve. Okay, small red curve from here. Okay, this is nothing but you'll be losing the premium here. This light red curve is nothing but that's your premium. Okay, and you're gonna be in profits from 13,780. What's the figure that we have got in calculator? It's 13,782. Okay, so you'll be profits in when market cross 13,780. Okay, see, this is a 13,780. 13,780. Look, from 13,780, you're gonna get profits. That means market should fall below 13,780 if you are choosing 13,800 strike. Okay, so the profit happens from 13,780. It starts from 13,782 to be precise. Okay, so risk is limited. The red line is flat till this point, and from this point there is a small spike in the chart in red color. This is nothing but premium. You'll be losing the premium, right? So this small spike is the premium which you have, which you're gonna lose. Okay, so and this is a break even point which is 13,782. So you will be in profits when market is falling down below 13,782 when you are choosing 13,800 put strike. Okay, all right, let's get on to slides. So profit is unlimited. This is done, and profit happens when strike price of long put minus. You need to calculate. If you're lazy to calculate, just get on to Opstra and analyze. You'll understand. Okay. All right. What are break-even points? I already explained you. Break-even point is a point where you get nothing. You will end up zero. Okay. You'll end up at zero. So formula for calculating, I have already calculated. See, break-even point is strike price of long put. What is the strike price of long put? 13,800, right? That's the strike price of long put minus premium paid. What's the premium? 17.5. Okay. So 13,782 is a break-even point. So 13,782 is a break-even point. So if market gonna end at 13,782, then you're gonna lose nothing. Okay. So if it is falling beyond that, you will get profits. If it is rising above 13,782, then your risk is limited. Okay, you're gonna lose some money. All right. So payoff chart. I have already explained this. Okay, let's move. So this is an example of how to choose. I mean, how to enter values in. I mean, how to use Opstra. Okay, I already told you. You just need to go to Google, type Opstra, and click on first link which appears, and click on Get Started. Then after clicking on Get Started on the next screen, you'll see this screen. So if you're dealing with Nifty, click Nifty. If you're dealing with Bank Nifty, click on Bank Nifty. Okay, and select features, select options when you're dealing with options, and select the expiry and select the strike price. If you're let's select Bank Nifty for a change, or let me refresh. All right, let's select Bank Nifty and let's select options, and let's select 14th January as an expiry. And what's the current price of Bank Nifty? It's 32,084. Okay, 32,084. So imagine that market gonna fall below 32, 32,000, right? So imagine that market gonna fall below 31,800 before 14th of January. So we're gonna buy put. So in this scenario, I'm expecting that Bank Nifty index will fall below 31,800 before 14th of January. Okay. So I'm here, my view is bearish. So I'm expecting the Bank Nifty will fall beyond 31,800. So I'm going to buy put. Okay. Before 14th of January. That should happen before 14th of January. That's the weekly expire. So I'm buying put here. I'm clicking on add position. So this is how the payoff chart looks. So if my view goes wrong, I'm going to lose 5,625. If my view goes right, then look at my profits. If it is falling down to 29,371, look at my profits. That's 55,100. If it is falling down to 28,653, look at my profits. That's 73,000. If it is falling down to 30,737, then I'm going to get 20,950 rupees profit. Okay. So instead, if my view goes wrong and if it is going up instead of falling down, then look at my loss. My loss is limited. I'm going to lose only 5,625. Okay. So that's how you should be using Opstra website, and that's how you should be looking at payoff diagram. And this is your break-even point, the point at which where you get nothing. Okay. So there is a color change here from green to red. So look at that point. That's your break-even. Or look at this point. Here it will be notified as break even, and 31,575 is your break even point. So market should, if market ends up at 31,575, then you will get nothing. You will be at zero profit, zero loss. Okay. So if it is falling beyond 31,575, you will get profits. If it is moving above of 31,575, then you will be losing 5,625. Okay. All right. So that's all about payoff chart. And this is how the chart looks. I mean, payoff diagram or payoff chart. That's how it looks. Okay. Effect of volatility. Effect of volatility on long put. So it's very simple. Higher the volatility, VIX or IV, good will be the movement in the market, which benefits long put positions. Okay. So same effect. Yes, yes. Long calls and long puts need high volatile market. Okay. Volatility is nothing but the speed at which the market moves. Okay. It tells with how much speed that market or premium can move. Okay. So higher the volatile, good will be the movement in the market, which benefits longer put positions. Okay. And effect of theta. You already know theta. Theta is nothing but time decay. If it is taking more time to hit your target, uh, it's, I mean, if it is taking more time to hit the target, it won't be, I mean, it won't be beneficial. Okay. It should take, I mean, longer to put position should take less time in hitting your targets. Okay. So theta will have negative impact on long put positions. I repeat, theta decay or time decay has negative impact on longer put positions. Okay. So longer put needs quick movement. I mean, if market is falling down, that fall should happen very quick. That fall should happen very quick. Okay. So when you're dealing with long put strategies, when you're going long on puts, you need to be scalping. That means you need to be trading in few minutes and seconds. You need to capture that moment in less time. Okay. So longer put needs quick moments. Okay. So theta decay or time decay has negative impact. Okay. So if it is taking more time to hit your target, it won't be much beneficial for longer put options. Okay. So your target should get hit in less time. Okay. So if the target is achieved but slowly, yeah, that's what I have explained. So if target is achieved but slowly, then you will face losses when you're in longer put option. That loss is because of theta decay. Okay. So if it is taking more time, just like remember Fortuner example again. Okay. It's pretty simple. The value of the car will fall. I mean, if today if it's 30 lakh, in next 5 years, the same car will be available at 20 lakh. Okay. I mean, that's the time decay. Okay. So options also decay, and they decay very faster when they are closer to expiry. Okay. So longer put needs quick movements. Okay. So if it is taking more time to hit your target, decay happens. So time decay happens, which is nothing but theta decay will happen, and that will eat all your profits. Okay. So that's why you need to capture good moments in quick time when you're dealing with long put strategies, long put option strategy. Okay, I mean you need to be scalping the good moments. So important points to keep in the mind while dealing with long put option strategy. Very simple. So going long on out of the money puts may be cheaper. Hey, remember that strikes which I have showed you that they are available for 3 rupees, 5 rupees, 6 rupees. Let's get on to chain option chain table. Look, these are all out of the money puts. Look at the premiums: 2 rupees, 2.7, 2.75, 3.30, 3.75, 3.85. All these are very cheap, right? So that point is about them. So going long on out of the money puts may appear cheaper, okay, but the put options have higher risk of expiring worthless, okay, worthless. So if you think that they are available for cheap, if you go beyond them, you'll definitely in loss, because I mean they need, I mean the more out of the money you are, the more bearish you are. Okay, so market won't be more bearish in most of the days. Okay, so don't choose cheap or deep out of the money puts when you are when you are dealing with long put option strategy. Okay, you need to be focusing on ATM strikes or slightly OTM strikes. Okay, so don't go for cheap OTM strikes and don't fall for traps. Choose or slightly ATM or sorry, slightly OTM or ATM strikes when you're dealing with long put option strategy. Okay, so in the money puts are more expensive than out of the money puts. We already know this. See, this is in the money puts. Look at the price: 672, 700, 500, 400, 161, 194, 229, 360, 455, 700. Okay, so in the money puts are very costly. Okay, in the money puts are, I mean premiums of in the money are more when compared to premiums of out of the money. Okay, so that's common point. So focus on ATM strikes, I already told you, or slightly OTM strikes when you are bullish. Sorry, when you're bearish, that should be bearish. Ignore this mistake. Okay, so focus on ATM strikes or slightly OTM strikes when you are bearish and want to buy put option. Okay, so more or deep OTM strikes you choose, more bearish you are. Okay, I already explained you that point in our previous slide. So long put long what should be, I mean what are I mean what should what is the role of option Greeks? Okay, so I'll be explaining the role of option Greeks on long put option strategy. Okay, so long put option strategies, long puts need high volatile market, that's what I told. And we need to choose strikes which will be having high delta and gamma. Okay, nothing but, I mean deltas and gammas should be. Let's get on to quants app. Click on option chain here. Look at the delta. You should be choosing deltas which are close to 0.50 or 60. Okay, so this is delta 0.5, 0.6. Okay, you need to be choosing strikes which are having deltas around 0.5, 0.6. Okay, more than 0.5. Okay, so high delta and gamma will have positive impact on longer puts. Okay, remember that point. That's very important. So when you're dealing with longer puts, you need high volatile market or high VIX market. Okay, and you need high delta and high gamma. Okay, so that will have positive impact on longer puts, and longer puts need quick movement. I already told you this. And theta will have negative impact. I already told you this. I mean, if it is taking more time to hit your target, no faida. Okay, you won't get profits if it is taking more time when you're dealing with the long put option strategy. We need quick movements, and our target needs to be achieved in very quick time when you are dealing with long put option strategy. Okay, so always have a look at option Greeks. What are option Greeks? Delta, gamma, theta, and IV. Okay, you need to have a look at all these things when you're dealing with this strategy. Always have a look at option Greek and payoff diagram. Payoff diagram is must. It's mandatory. Okay, so instead of looking at your profit and loss in your broker, look at Opstra. Look at payoff chart. You'll learn a lot. Okay, it tells you how much you're gonna lose, how much you're gonna gain, what will be the risk, what will be the maximum reward, and what will be the break even. Okay, you need to be looking at payoff diagram, payoff chart. It's must. Okay, and don't go long on puts if it is Thursday. It's an advice. Do not go long or do not buy puts if it is Thursday, which is nothing but weekly expiry day. Okay, so theta is more powerful on Thursday, so more decay happens on Thursday. So it's not suggestible to go long on put options if it is Thursday, weekly expiry or monthly expiry. Okay, so we should be watching stock or index chart instead of looking at individual stock strike price and individual options strike chart. Okay, see, so if you're dealing with 13,800 put, you need to be looking at original Nifty stock. I mean, original Nifty chart. This is original Nifty chart. Okay, so you need to be making your analysis on this only. You should not be looking at that PE chart or CE chart, which is this. This won't teach you anything. See, the chart will be very messy. Okay, so do not have a look at PE chart or CE chart. Okay, instead look at underlying asset chart, which is you need to look at Nifty chart or Bank Nifty chart instead. You will learn a lot. Okay, so that's an advice again. So we should be watching underlying asset or Nifty or Bank Nifty chart instead of looking at individual option strike chart, which is nothing but do not look at PE or CE strike chart. And probability of success in long and put position is very less. Yes, that's true. So probability of success in long and put position is very less because it need high IV, quick movement, and that strike price should be very far from the expiry. Okay, because like I told, time decay happens faster on Wednesday and Thursday, so it's not suggestible to use long put option strategy on Wednesday and Thursday. Okay, so as most of the times market moves sideways. Okay, let's read 2 and 3 point together. Probability of success in long put strategy is very less because it need high IV and quick movement, and that strike price should be far from expiry because as most of the times market moves sideways and option buying is not preferable. Okay, and if it is close to expiry, theta will eat all your profits. That is nothing but time decay. And if target is achieved slowly, then also profit will be eaten by theta or time decay. Remember that point. In simple words, okay, in simple words, if you expect a bearish market, imagine that you have made some price action analysis and imagine that some trend line broke, some major trend line broke, and the market is falling down. Okay, in that scenario, if you want to deal with options, you need to buy put options. Okay, because market is falling down, market is bearish. Okay, so if you expect a bearish market, you need to buy ATM or slightly OTM puts. I repeat, if you expect a bearish market, you need to buy ATM or slightly OTM puts. Okay, so pro tip, here are some pro tips. Okay, so we have experimented everything, so it's really essential for you guys to follow what we have taught. Okay, I mean, I'm not asking you to stop trials. You need to I mean, you need to try new things and explore the market. I always encourage students to explore market and try out their own things. But what I'm suggesting is, with our experience, we have experimented everything. With our experience, we have I mean, we have wrote few really important points, and we have uh, written down all the lessons which we have learned. Okay, so I'm talking with a lot of experience. Okay, so if you get during your initial stage, instead of trying new things, you need to be following us. Okay, you need to be following what is taught. You need to listen to what are important points. Okay, you need to follow things which we have taught instead of trying out new things when you are new to the market. Okay, when you are new to some segment or futures and option segment. Okay, you need to experiment when you are confident on what was taught. Okay, so here are some pro tips. These are written with experience, so it's advisable to follow this. Okay, so if it is Friday and Monday, if market is bearish, buy puts. Okay, so I already told you, you already know which strike to choose. Okay, so If it is Friday and Monday, if market is bearish, if it is falling down, buy puts. Okay. So if it is Tuesday, Wednesday, and Thursday, what shall I do? Keep that excitement. I'm gonna answer this question in next sessions. Okay. So all right. That's all for today. If you guys have any questions, if you guys have any questions, and if you guys having any difficulty in understanding some concept, or if you guys having difficulty in understanding some slide, immediately call me up immediately, or message me anytime. Okay, I'll be responding to each and every message. I'll be answering each and every call. Okay, so I'll be helping you throughout your lifetime. Okay, so I'll be helping you, I'll be educating you. If you love, if you guys love my sessions, and if you're very confident on what is taught till now, so please like this video and subscribe to our YouTube channel. Thank you guys, thanks a lot. Thank you everyone.